Welcome to Real Vision Crypto. I'm Ash Bennington. I'm joined today by Richard Kim, general partner at Galaxy Interactive, to talk about gaming, social tokens, AI, Web3, and so much more. Richard, welcome to Real Vision Crypto.
Thanks for having me.
So, Richard, you've had a really interesting life. We were talking a little bit off camera. You're someone who could have done just about anything, and you wound up in the crypto space. Tell us a little bit about your background before you got to Galaxy.
I started my career in the heart of the financial crisis in '07 on the legal side, where I worked at Cleary Gottlieb right out of law school, which is a big law firm in New York, focused on derivatives and regulation. Which was an interesting time during peak financial crisis. It was an environment where I was thrown into, thinking about questions like what happens when Goldman, issues an early termination notice against Morgan Stanley, which obviously didn't happen, but was very close to happening. And so analyzing the implications of these kind of cascading defaults and such was something that occupied the first year of my career. After a few years of being a lawyer, I realized that was kind of like being the world's greatest expert at literally a paragraph or two of the bankruptcy code. Kind of like, knowing how to fix an incredibly arcane part of a car, but not knowing how cars run. So in 2010, I moved over to the JP Morgan initially on the legal side to kind of broaden my horizons a bit. And by 2012, I'd moved over to the FX business to be a business manager in FX options. Over the next few years, I essentially became the COO of FX and emerging markets trading at JP, and was quite involved in the electronic trading franchise in particular, and really seeing through the changes that were necessary to bring a spot trading desk and kind of old world FX franchise into a kind of electronic first regime. And so I think a lot of those lessons were quite interesting to me in looking at crypto, where I first moved over to Goldman in 2015 to do a similar role as I had at JP. But by 2017, I started to look into crypto, mainly with an eye towards figuring out how to get Goldman trading crypto, because to me it was just another FX pair at the end of the day, settled differently. I was surprised in 2017 to see the intensity of the negative reaction to that from a, call it, internal business development standpoint. By the end of the year, had really morphed quite substantially in line with the rise in crypto markets that year.
There's probably this sort of equal skepticism on the outside of people in the crypto community, in the Bitcoin community, especially, I would imagine, in 2017, who were probably not thrilled about Goldman getting into the business.
It's interesting. I'd say at the time, there was so much speculative fervor, particularly by the end of the year, that everyone was looking for any headline that would propel the rally, basically. So I'd say it was actually pretty universally positive, with a lot of anticipation on what that offering might look like.
Yeah.
I remember being on, the kickoff call and having 157 compliance people kind of attend that first meeting. And I had the general counsel at the kind of corporate level call me and say, you got to manage this process better, because everyone wanted to be part of a movement, right? I mean, crypto was the thing. And then 2017, when you get used to, these zero-sum markets where you're talking about pips and fractions of this or that, to talk about crypto was really captivating a lot of the minds back then. And so, I was really proud of that initiative. And I think Goldman could have actually stood up something pretty quickly, but I left in the first quarter of 2018 to join Mike Novogratz at Galaxy Digital, initially as the COO, but within the first few months of 2018, eventually by the end of 2018, joining full time on the venture side with my current partner Sam. And together we're the two GPs at Galaxy Interactive, which is a $650 million franchise, completely focused on the interactive entertainment space, and this idea that our digital identities have become just as real as our physical ones.
Let's zoom the camera out for a moment. For people who aren't familiar with Galaxy Digital, tell us a little bit about what Galaxy Digital does and then how Galaxy Interactive fits into that schema.
So I guess let me rewind to when I first joined Galaxy Digital and the reason I joined. I mean, to me, it was a really interesting mix of kind of startup like potential. When I joined, there were a couple dozen people. Now we're in the hundreds. We had just raised, a couple hundred million to essentially go public on the Toronto Venture Stock Exchange, which didn't end up happening until I think it was August of 2018, sometime in Q3. By which point the markets looked substantially different from when the funds were initially raised in the first quarter. So it was an interesting environment to be thrown into. The kind of all the pre-revenue, frenetic nature of a startup, but with a lot of the kind of institutional and compliance infrastructure of a public company. The idea behind Galaxy, which has always made a lot of conceptual sense to me, is this is your beta to the idea of the institutional version of crypto hitting mainstream, right? So that includes a trading business, an asset management business, a banking business, and a principal investments arm. Within the kind of principal investment slash asset management side of things,
for people who are not familiar with the traditional financial space, that's a huge amount of coverage that you guys are doing. I think Steve Kurtz said it in some ways it's like Goldman and BlackRock together, because you guys have the sort of the banking side of the business, or the plumbing side of the business on the one hand, and on the other you have asset management and a venture arm. I mean, it's just an extraordinary amount of space that you guys are covering.
Yeah, I mean, I think there's the access side of things, but then there's also just the synergy side of things. So, I think over the last few months in particular, it's been gratifying to me to see that finally realized. From a lot of the early ideas three and a half years ago or 4 years ago to now actually being implemented in practice. So, on the venture side, my partner Sam had raised the $325 million Galaxy EOS VC fund, which started as a ecosystem fund focused on opportunities on the EOS blockchain. And one of the kind of early observations we had in looking at the sector was, to the extent the EOS blockchain in particular was going to be a blockchain that had an impact in the world. The best shot of that happening was to invest in the applications and founders who are most likely to make a practical impact in the world, as opposed to just talking about a blockchain pitch. And so we quickly honed in on the interactive entertainment sector being pretty interesting because of the foundational unlock that blockchain provided in providing a fungible layer for virtual goods to be traded, exchanged, and for you to finally own monetary value in a lot of these gaming ecosystems where, I'd say there was a lot of sentimental value, as evidenced by the fact that gaming is a $175 billion a year market. So a lot of consumption value, but not a lot of investment value, right? Arguably, the ROI of buying a Fortnite skin is, in pure monetary terms, minus 100%. Now, obviously, players don't look at it that way.
Right.
And if anything, the crypto world has gone too far in the direction of, oh, you're getting no value for all these purchases in game. I mean, that's a pretty ridiculous statement because of the consumption value. But the interesting thing to consider is whether you can get all of that entertainment slash consumption value out of virtual goods while also tapping into real world value in a way that the extrinsic motivations of doing so don't essentially completely swallow a lot of the intrinsic joy you get from this activity. And that's probably worth exploring later on.
Yeah, that's a sort of a fascinating point. There have been all of these studies that show that there's this sort of almost an inverse relationship between external motivation and internal motivation. Sometimes it's a fascinating idea. But before we transition to that, I want to bring up this graphic that you guys have at Galaxy Interactive that shows the scope of this space. Obviously, you can see it on your screen right now. This is something that is sort of a kind of complex, richly ramified space that you guys are thinking about. Walk us through this image and explain what we're seeing.
What you see on this slide is really the sectors that we've invested in as a fund. Now about 4 years into, 3.5 into our investing history, we've invested in 97 companies, and deployed, let's see, we've deployed nearly 500 million into these companies. And really the broad thesis here is that the rise of the self-sovereign digital native is driving one of the biggest consumer TAM expansions in the modern internet era.
Richard, what does that mean? The self-sovereign digital native. I think it's such an important concept. What does it mean and why is it central to your thesis?
A lot of the interactive entertainment space and gamers as traditionally construed, they've participated in kind of closed loop ecosystems and economies where, back in the day, like you and I will remember going to like Toys R Us and, buying boxed games on the shelf. Now it's much more of a almost SaaS-like business profile with microtransactions, subscriptions, and this sort of thing. But, a lot of these worlds continue to be fundamentally, closed world, top-down designed in nature. I think one of the interesting things that's happening when I say self-sovereign digital native, like when you hear this term Web3, right? A lot of Web3 is about empowering individuals with the infrastructure they need to, manage their own wallets, to interact and form their own digital identities when interacting with web applications, instead of the kind of Web2 version, which is a lot of, big central tech companies like Google, Facebook, et cetera, essentially controlling your identity. Right. So, we're still in the very early stages of this. Like, can we name how many mainstream consumer applications can you name that are fundamentally have the account, the ETH account, for example, as your identity? Not a lot. But what's interesting about the ecosystem is when a lot of these underlying puzzle pieces come together, the effects can be quite explosive. And so gaming, going back to this idea of the self-sovereign digital native, is one of those spaces where you have this concept of play to earn, which is the idea that you can instantiate virtual goods and virtual currencies onto a blockchain and thereby give them real world value. And create these essentially microeconomies where players can earn real value for their time, and also exchange virtual goods for real world value, right? So this idea of essentially freeing or unlocking the consumer, the digital native consumer, from being captive to these Web2 platforms, and really unleashing them in Web3 space, is this idea that's going to actually be quite native to a lot of the digital first generation. Like, whereas the older generation still ask questions like, oh, why are you buying Fortnite skins? Those aren't real, right? If you ask any 11-year-old, the first thing they want to do is buy skins and Roblox and for Fortnite because it's such a core part of their digital identity, right? And so you start with this premise that value is digital first, relationships are digital first, connections are digital first. You supplement that with the re-architecture of the modern web for the benefit of individuals rather than entities. And you combine that with the global leveling of creative potential and earning opportunity that a lot of the creator economy startup world is enabling. And you get this kind of explosive intersection of what we have on this diagram of, interactive content, finance, tech, and social commerce, really empowering this notion of digital first value.
I mean, these are really big ideas that we're talking about here. This idea of digital first value, the transition from this closed loop box gaming ecosystem to Web 2.0 and now Web 3.0, where your Ethereum wallet becomes your passport into this world. I mean, this is a pretty huge paradigm shift, probably the biggest paradigm shift in terms of the connection, communication, interchange of value that we've seen since the creation of the web itself.
Yeah, absolutely. And that's why, from a ability to see what's coming standpoint, we first started investing in games, 3.5 years ago, and we were the outsiders in the space. Um, I remember going to Slush and meeting the founder of a large public company in the gaming space now, and the word blockchain came up in the second sentence of the intro, and went on a 5 minute "I hate blockchain" rant. And that same individual is now a pretty active investor in a lot of crypto gaming startups, which I find quite funny. But it really shows that you could be the world's greatest expert in gaming 4 years ago, and you would have totally missed this intersection of markets and content and identity in such interesting ways that are all converging. So the ability to be cross-disciplinary in the backgrounds of your investing team is probably the most important thing. Like my background is markets, trading, and law. Sam's background is a lot of old world media investing, entertainment, film financing, this sort of thing. And across the team, we have some of the greatest experts in cloud gaming and video streaming, and a lot of the underlying technologies that are going to be core to powering a more immersive interactive entertainment experience going forward. So that ability to look at things from first principles without any pre-existing judgments, I think, is the single most important thing to kind of succeed in this space right now.
So this is just so fascinating to me, Richard, because you're in this unique sort of pivot point where you spend your day in this world, but you have this sort of very traditional background, JD from Columbia Law School, time spent at Goldman Sachs. It's so interesting. How do you connect this to people who are like, I get it. I know there's something happening here. I don't exactly know what it is, and I don't understand the significance of it.
I think it really is a generational shift. I think a lot of this is not about predicting some Ready Player One style future where, depending on whether you're an optimist or a pessimist, it's like this like crazy virtual reality thing. But much more, go look at, my test. I actually do this quite a bit. I ask my 11-year-old what he thinks about a lot of opportunities, because when you're 11, you're sharp enough to analyze things, but you're not scheming enough to like invent a bunch of BS. So, like my first question for him was, what's the metaverse? Can you tell me what the metaverse is? And he was like, I never use that term. None of my friends ever use it. Is that something Zuckerberg is building or something? Right? Like metaverse is like one of these things that probably 40-year-olds talk about,
Right.
who were imagining this world when they were 15, and they're finally seeing the potential of it, and that. But
Richard, so if you could only stay 11 forever, you would have an incredible, powerful investing thesis.
yes, exactly. Well, and so for him, it's not about these grand terms like metaverse. It's the fact that his friends are all playing Minecraft and they're co-creating these virtual worlds together. If you look at how kids play, a lot of it is not ends oriented. It's just kind of like exploration, right? Alex Danko wrote one of my favorite essays on this topic on how kids think. And, like when they ask that proverbial question, why, they're not actually asking. How adults interpret that is like, what is the cause? What is the causal chain of X leading to Y? Whereas when kids ask that question, it's really with a mindset towards exploration. So, as we get older, we sort of become jaded and try to bucket things into cause and effect. And Alex Danko described it as walking a tightrope. Whereas when you're a kid, you kind of just see things how they are. And it's kind of like playing in a jungle gym and seeing how the pieces fit together. And I think that is the type of mentality we have to bring to what's happening here, right? You look at, as I was saying earlier, just the volume of spend on purely virtual goods and microtransactions over the last 10 years. You look at the fact that we've hit some degree of saturation in free to play and mobile gaming markets, for example. Like how many subscriptions and games like Clash can you spend $30 a month in? Like, and so I think a lot of we're at this tipping point where it only takes one or two really great content experiences to fundamentally shift your mindset to this idea of earning value for your time.
How do you begin to apply that? So there's this kind of this unique insight that you've had about the way that younger people, kids especially, experience these worlds. This almost like Zen deconceptualized way of thinking about this space. How do you apply that, and how do you begin to then extrapolate the value proposition from that? In other words, how do you know what makes content that has these characteristics, these exploratory, open, connecting characteristics versus content that doesn't?
Yeah. So I'm not one of these people who thinks crypto gaming is going to swallow all of content. Like there, in fact, I believe the opposite. I think the vast majority of games will continue to be non-crypto games because the way I think about crypto is it's an open economy, right? And there is a certain beauty from a game design standpoint to fully being able to control from a top-down standpoint, your sinks and your resources and all this stuff to a level of detail that provides players with that right balance of emergence in terms of finding their own way of playing the game with a kind of loosely crafted progression scheme as well. Like to me, like Breath of the Wild's a great example I use all the time of a game that hits the nail on the head here. And if you made Breath of the Wild have a fungible virtual currency, like it just wouldn't work. The game would break down, right? So I think there is a class of open economy type of experiences that's going to be really transformational and probably are going to take multiple years to develop. And they're not going to be in the class of game of, hey, take an existing game and just make the currency a token. Like that will almost never work, which is why I think going back to Helsinki and Slush for a second, which is where a lot of the leading mobile game developers are. A lot of them are thinking about blockchain, but I think they're thinking about it wrong. They're thinking more in this mindset of, just make my token tradable or make my currency tradable, and that just it's not a sustainable economy, right? Like ultimately, I think user generated content and the constant creation of interesting experiences in the world and things for you to do with your money. Beyond the kind of top-down plan of the game designer is one of the most important sustaining metrics a game will have, right? So in terms of this question of what makes a game have that spark that makes it investable, like, we have a pretty good idea just because we have so many gamers on our team that, a lot of it is somewhat ineffable and knowing what's genuinely different from a player experience versus what's out there. But again, it's a fine balance. It's not one of these things where, because we have people on our team who are like encyclopedias of games, that they have all the right answers.
We've talked a little bit about, you talked about first principles, this idea of what you begin with. So what are some of the definitions here? What exactly is a blockchain game? Is it something like Axie Infinity? Is it something where you are just authenticated using your Ethernet wallet address? Is it something where you have the ability to trade assets in a gaming ecosystem? How do you think about that term, and what are the different permutations or functional subdivisions of that term as you see it?
Yeah, it's a good question because there's various degrees of depth you can go into in terms of integrating blockchain into your game. The most straightforward way is keep the existing corporate structure as a game studio with equity investors, and you make revenues through essentially fiat, microtransactions, and subs, but sell NFTs, right? So that's like step one, and you sell the NFTs for some combination of crypto and stable coins, and all that stuff gets converted back to fiat, right? So that's the easiest to understand. It raises the least amount of regulatory risk. The next evolution of this is create a fungible virtual currency that players can earn. And this virtual currency does stuff, in the game, has some utility, like whether for breeding, for land plots, for whatever utility that you can come up with for currencies in your game. The main question here is, do you sell this currency or not? Because if you just give it away, it's a great incentive mechanism for players to play your game. But ultimately, if this thing gets traded on open markets, as your player base expands, unless you have like a constant buy side pressure of people willing to buy this currency to speed up progression or otherwise, the value of this play to earn currency is probably going to tend towards zero, right? So call that the grind currency. And then you have the deepest evolution of this, which a lot of people are calling today governance tokens because they don't want to run afoul of securities laws and other complications. But here the idea is like, imagine if you could reinvent the organizational structure entirely of a game studio, where yes, you have a lot of the top down creative direction, but you also have a organizational structure where all of the economic value and governance value of what you're building accrues to the benefit of token holders. So you essentially strip equity out of the equation. So the mental model here is, imagine like Fortnite. We're not a part of Epic Games, but Fortnite were developed by essentially a collective of programmers, artists, and other creatives working to build this game, right? And they essentially pay themselves with community support in this thing called new V-Bucks. And all the transactions in the ecosystem are denominated in new V-Bucks, right? And so the idea of creating a virtual currency at the core of your game experience that also serves as the incentive mechanism, both for those building the game as well as those playing the game, that's really, really interesting, right? Because then you have this incentive alignment across the board. You can reward early adopters and all these other great benefits. The issue is, the more it looks like real value being put into this currency, the more it feels like a security, right?
And I don't want to sort of engage in hyperbole here, but this is really, in some ways, the biggest shift that we've seen in terms of the nature and structure of how activities get organized since perhaps the creation of the joint stock corporation. It is a huge idea with a lot of different sort of aspects to it. How do you organize things in a way that creates this balancing act between chaos on the one hand and excessively structured rigidity on the other? And then to your point, this question about where do we stand right now with securities regulation, because this really does begin to sound, as you discuss it, like something that meets the Howey test. This is the test that regulators use to determine whether something is or is not a security. How do you even begin to think about these things? Again, you're uniquely positioned, Richard, as someone who has this background in the law and who spends their days in this space. What's the current state of play in that debate? And how do you describe that, particularly to people who aren't lawyers and who don't have the background that you do in the gaming space? How do you even begin to think about that?
So the short practical answer to your question, how the market's dealing with this today, is that US people are being systematically excluded from every interesting token sale, airdrop, et cetera, with limited exceptions. Which is unfortunate, right? You can look at things like DYDX, which had to systematically exclude US people from the airdrop. DYDX is a decentralized exchange.
I've actually sat down with Antonio Giuliani here on Real Vision. Fascinating young guy.
And there, some US people were excluded to the tune of over $100,000 of airdrops because of securities law issues. And so the vast majority of token projects I see in the particularly gaming space are systematically excluding US people from both the airdrop as well as any private sales, which it's somewhat unfortunate. I'm sure we could wax on for 30 minutes about the public policy kind of ramifications of all of this. I do think fundamentally, though, there is this tension between two things, right? One is this idea, and I'm sure we'll get to DAOs, but there's a way to structure a DAO assuming it really is a bunch of, call it equal participants who band together in support of some shared passion or cause. There's a way to structure that looks a lot more like a co-op uh, than a security, right? And so where and if something is a co-op, it's not a security. And so where on the sliding scale of participation you sit for any given project.
Can you explain that? Just unpack what that means. First of all, talk a little bit about DAOs for people who don't have that background, and also describe what you mean by co-op and why it is not considered a security.
Yeah, I mean, there's a long history of case law in the U.S. in particular about when you have a bunch of people banding together in some kind of shared cause, you don't really have that element of the securities laws that in the Howey test where you're relying on the central efforts of a promoter. So like if on the one hand you have a mechanic where like one person or a group of people is saying we will go do X. Buy this thing. That's security like. Contrast that with you and I and like 10 other people going and creating a club to go buy NFTs together. Like that's more like a partnership or a co-op, and not a security because of the kind of active participation of everyone involved. And so I think these kind of internet native communities and organizing structures are going to have a lot of tension and uncertainty in terms of where on the spectrum they sit, right? Particularly for gaming, right? Because gaming, you'd be hard pressed to make the argument that, given the game studio is the one building a lot of the framework of the experience, that what they were doing was not kind of more security like, and and they all have this plan of, oh, eventually when we hit a certain point, we will turn into a DAO and turn into that collective where the community decides everything. But that's quite far away for a lot of these projects. And so
it's also incredibly easy to say, right? It's just an incredibly facile response to be able to say, well, yes, and at some point in the future, when we reach scale, we're going to decentralize this and the community is going to run it, right? Like that's like just an incredibly easy, generic sort of thing to say. But how you build that sequence, and is there a way to do it where it begins organically in this more co-op framework? A really interesting question.
Yeah, and then the other dimension to think about, in addition to the co-op / partnership versus security, is another axis of like utility token versus kind of a promise of something in the future, which looks more like a security.
But does this let's define first of all for people who don't know what a utility token is, and secondly, is there any sort of case law around this idea of regulators accepting that the concept of a utility token exists? But before we get into that question, please, why don't you define what a utility token is?
Yeah, so this gets very technical very quickly. So I'm going to keep this conversation at 10,000 feet to the point of not being legal advice or anything.
Yes.
But broadly, the framing of the issue is the more your token feels like something that can be used in game for something, like for something concrete, as opposed to being a piece of paper that says, I promise to build XYZ, and in the future, this thing will have value in proportion to XYZ. Like that's more security like. What's more utility like is you can use this token to breed axes, or you can use this token to do XYZ function in game, right? And so obviously you can have a hybrid of these things where, again, things get gray, but people generally try to fit more on the utility / currency side of things than the I promise I'm going to build you something speculative and interesting in the future side of things, right? So you have all of these dimensions to think about in the token space, which effectively leads a lot of projects to explore tokens, but feel like there's just too much risk to expose their player base to it. And then I guess you have this more recent dimension that you see from a lot of large gaming publishers of their player bases having this viscerally negative reaction to NFTs and blockchain. Like we've seen it with Square Enix, we've seen it with Ubisoft, and a couple of others. And really what's guiding that is, these players have gotten sick of a decade of loot box, hyper monetized, kind of free to play that is not free to play at
Can
all.
you explain what that means, by the way, for people who aren't gamers?
For a game like Breath of the Wild, you pay $59.99 and that's it. There's nothing in the game that says, "Hey, if you want this shiny sword, here, spend another $10," right? And so in mobile, which is the vast majority of gaming revenues to be these days, most of that mobile revenue is in the form of microtransactions. In other words, these kind of in-game either have like some progression based reason, like speed up production if I pay this many gems for something, or like at the cosmetic layer you can have this shiny sword if you or skin if you pay this many gems. And that's gotten to the point where like everything has gotten hyper monetized, and so players look at this hyper financialized construct like NFTs and they're like, my god, this is like microtransactions squared. Where is the world heading? We're going further and further away from the, call it, Breath of the Wild type of, you pay once, you get what you pay for, and you don't get bothered anymore, right? I mean, that's what you see a lot of the negative reaction to, which at an intellectual level is somewhat ironic because the ability to trade your items is a great way for players to vote with their feet if they don't like the direction of a game, right? And that's optionality they never had before. So, like, why are you complaining? On the other hand, going back to the whole extrinsic versus intrinsic thing, it's undoubtedly the case that the more you talk about financial mechanisms in kind of immersive content experiences, done badly, that takes you out of the immersion, right? And so defeats the very purpose of you wanting to play that game in the first place.
I mean, it is just so fascinating. When you play these games, it can be a really frustrating experience. I've heard the phrase "pay to win," whereby you basically feel like you don't have the opportunity to actually compete in a way that's competitive in the game unless you upgrade your bird, upgrade your slingshot, spend a whole bunch of gems, which are real money that you're actually having extracted from your account, whether it's on the iTunes store or the Google Play Store, where you really feel this frustrating experience, and some of it is because this is still, I think, a very centralized entity that you're paying. There's not this sort of the community involvement yet in this. There's not the sense of community ownership that seems to drive so much of the digital asset and crypto space in ways that makes the participants in those communities feel like owners. I don't think we're there yet.
Yeah, I agree. And like a lot of the word community gets bandied about these days in DeFi, profile pick communities and other kind of hyper financialized constructs. And every time I see the word community in that context, I'm instantly skeptical because I ask myself, what are the shared interests and values that bind this community independently of the pursuit of profit? And you often find, the answer to that is nothing. So yes, in a time of strong beta, everyone is uh, each other's best friends, and our community is super strong. But that won't always be the case. And one thing we talk a lot about on the team is uh, if I want to be uncharitable about it, you can call it like the shortening of the Ponzi cycle. Like if you have a skeptical view on a lot of these things, that they're essentially just narrative Ponzi's that early adopters can kind of pump up until they get a bunch of people excited to buy in, and then they leave and go find the next one. Um,
Right.
there is a real risk we will see this in play to earn space, right? Because you won't know for play to earn for several years, like um, whether one of these titles, like I don't know, Star Atlas or whatever, is going to actually be delivered in the way that meets the original expectations. And by that point, from a narrative standpoint, there will have already been 100 new kind of play to earn opportunities, right? And so that is a risk. I think from a business model standpoint, it actually has pretty deep implications to things like guilds, for example. Like most guilds today are focused on Axie.
Can we define guild for people who don't know what that term means?
Yeah, I mean, guilds have been around in MMOs and kind of other gaming experiences for a long time. Often you have a group of players essentially banding together to go on raids and get loot in games like World of Warcraft together. So just think of it loosely as like social constructs and collectives that form around kind of in-game experiences. In the crypto context, um, you have guilds like YGG, Blackpool, and others that are this kind of hybrid social structure as well as asset management vehicle. And the reason they've become asset management vehicles is because these games are not free to play. You actually need like $1,000 or whatever it costs to field a team of three axes, right? And there's a disconnect between having the capital to buy these axes and having the marginal cost of your time be sufficiently low that you're willing to do it, right? Like if you go back to Econ 101, when do goods stop getting produced? It's when marginal revenues equals marginal costs, right? And so marginal revenues in this construct are, the incremental SLP in the case of Axie that you're earning, which is that their kind of grind currency.
Smooth love
Yeah.
motion. We have to keep jumping in to talk about all of these acronyms. MMO is massive, multiplayer online game.
Yeah. And the marginal cost of time is it's not going to be your kind of, average person in the US. It's going to be someone in the Philippines, or it's going to be someone in Brazil, or it's going to be a kid who has a low marginal cost of their time, right? So like it is interesting to think about the implications of what I call like the modern industrial revolution here, right? Because you have all the same mechanics around capital and labor and the allocation of capital to labor just at global scale now in constructs that are about like 100x faster than the equivalent of setting up a railroad back in the day. And so I think that is really interesting because I think games have the potential to be one of the first truly global labor markets where anyone can spin up a collective at global scale and command vast resources of time and energy towards pursuits like, for example, mining or farming in this game or that game. One thing I've been pondering is whether we had a long debate on our team last night about this. I tend to think there's room for asset light guilds, like a lot of the Axie guilds have essentially become very asset heavy because they've had to buy these Axies to lend out to their players. And that's a core reason for their value prop is the ability to essentially take a share of the scholars' earnings over time and lend them the upfront Axies so that there's no principal outlay, right? Going forward, I see significant potential for a lot of this lending functionality to be insourced within the game itself or outsourced to kind of protocols and other startups building infrastructure to facilitate efficient markets, right? And that leaves the guild as more the kind of like marketing collective slash social vehicle where you see this in NFT space. At any point, there's so many NFT projects that you've had these kind of curation layers start to crop up, like what Kevin Rose does with Proof Collective, for example, that is like this membership only. Here's the stuff you should focus on to separate signal from noise. Like I see a lot of potential for that. Whereas some folks on my team don't. They feel like that's kind of reinserting a lot of Web 2 organizational structure into something that gamers fundamentally don't need, and they're not stupid and they know how to allocate their time. So expect to hear a lot more about this kind of capital versus labor narrative as the range of playable experiences expands to the dozens and even hundreds in the coming years.
We were talking a little bit off camera about social tokens. One of the things that I find really fascinating is we've talked about gaming as a pure play experience, but this idea of the sort of the gamification of everything, the ability to use some of the constructs and paradigms that have existed in gaming more broadly. Talk a little bit about what social tokens are. Obviously, this is something that someone in the media business like me is fascinated by. What are social tokens, and what's the potential significance that you see behind them?
So I became fascinated by this topic after creating my own social token community called RNG. And let's see, it was at the end of 2020, where basically in the last quarter, I announced on Twitter, hey, I'm going to start the social token community. It's going to have a token, and the idea was to create like a digital Soho house, basically, except that instead of paying for your membership, it was owned by the earliest members. So not only did you get in for free, but you have the upside of of whatever vibe value these early adopters would generate. And the first few months was some of the craziest of my life. Like I'd spend hours in Discord, essentially like overseeing the distribution of tokens through all these like mini meta games, whether kind of Discord bot games or kind of creative competitions around the production of art on a theme. And like I learned a lot about what makes communities sustainable versus not. One, I realized like you constantly need a use for the token. For these communities to be vibrant, right? Like people are willing to suspend disbelief for a few months and spend all their time earning these tokens if they believe there's some prospect for doing something with them in the future. But if it's only about earning and you can never do anything, that fundamentally is pretty unstable. And at a certain point, I had a day job and I couldn't focus all my time on, on cultivating this community. So I mean that taught me some valuable lessons about, where you see social tokens talked about a lot these days is in the creator economy context, and like, can I as either could Kanye release a social token? Yes, for sure. And that would be instantiating a lot of the fan and engagement value that's very real in the form of a token. But the easy part is creating the token. The easy part is seeing your token pump like 100x versus wherever you list it. The hard part is creating a set of experiences for token holders that gives them value above and beyond like the utility value of the token, right? Because if these social tokens only ever, essentially get composed of what they're exchangeable for, then you don't really need a token at all, right? You could just use dollars. And like if it's about, hey, you can have dinner with Kanye, like that has a monetary value and you could have just charged dollars for that, right? So why do you need a token, and where is social tokens best like the best construct for it? It's when you have a lot of community created content where you have a group of people who are willing to use this social token as the native numeraire of the ecosystem. Like in RNG, one of the most successful use cases was we would have these creative competitions on a theme and ask people to create art. So the community would create the art, curate the art in terms of figuring out who through just simple voting mechanics, whose pieces they like the best. And then the top three, we would go mint and then sell back to the community in the native token RNG, right? And the reason like a loop like that is fundamentally a good thing is you don't require these Ponzi like, hey man, buy my token for progressively higher and higher rates, which kind of leads me to some observations on the PFP space right now, the profile pic space. One of the things that a lot of these social token communities discovered pretty early on is there's a paradox between the desire to expand your user base and the desire to maintain some cultural consistency and exclusivity around what you're doing. So it's the same for someone like a Bored Ape, which is now trading at floors above 100 ETH. When your cost of membership is that high, it really limits your flexibility to have as your mentality one of abundance, not scarcity, right? So much of Web3, you hear the benefits of it being digital scarcity, and that's undoubtedly true. But if all you're indexing for is scarcity, then you're going to have a very small community with limited mainstream impact, right? And so the higher these tokens and NFTs get, the more your singular focus has to be on maintaining the floor. Why? Because if your floor falls, you're going to have a lot of really unhappy community members that bought in at the highs and suddenly find their stuff is worth half as much, right? And that's just not fun. So yeah, that's a real tension. And ultimately, the communities I think are going to be successful are those that can create these internally consistent metagames that don't require external sources of funding and have this collective myth of the common currency being the overarching mechanism. And I think that's one disadvantage that NFTs have relative to tokens, because NFTs are more clearly in the membership pass bucket or the kind of commodity bucket than they are the common currency bucket. Um, and I think it's ultimately the common currency bucket that's more interesting in the long run.
So vast opportunities, trade-offs, and paradoxes. I feel like we could continue this conversation for another 4 hours, Richard, if we wanted to. But I really want to thank you for joining us here today. So much that we've discussed, I think, has opened my mind, and I think that of our viewers. Thank you again for joining us.
Yeah, no problem.
Thanks for watching, everyone.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.